This conference will now be recorded.
I just got the message. It will now be recorded. Okay. So basics of accounting. Accountants are not really, they can be very smart, but they're not very creative, I think, for the most part. And so everything matches. Double entry bookkeeping requires that there is an entry for a debit and an entry for a credit, and everything has to balance. So the basics of accounting are assets equal liabilities plus equity. Income minus expenses equals net profit. That's pretty easy. And then cash flow. So cash flow equals net profit plus cash flow from operations plus cash flow from investing plus cash flow from financing. And that can also be minus if those things go into the minus. Okay. The basic rules, as we just went over, you need to have 2 accounts for each transaction. There has to be 1 account that gets debited and 1 account that gets credited. Expense accounts are debited and they show a debit balance. Revenue accounts are credited and they show a credit balance. Asset accounts, typically, unless it's a contra account, will have a debit balance, and liabilities and equity, unless they're contra accounts also, will be increased by credits and will also show a credit balance. I know we all did accounting in school. Stop me if that makes sense. If you want me to elaborate. No, probably everybody's at work. So I hope that made sense. Okay, here is how we're going to run this. Accounting is best done visually. So I am going to run through examples of these things. So I'm going to share a slightly different screen and have you see, or I'll just pull this over here. No, I'll just switch sides. So this is my QuickBooks, and most accounting systems work very similarly. Here's what my balance sheet looks like right now. I'll go to reports. I'm going to go to my balance sheet. Here's what my balance sheet looks like right now for this company that I made to do this class. This is how most of them look like. These are obviously very round numbers. But my balance sheet is, here's my list of assets. So if I go back to my basic rules of accounting, assets equals liabilities plus equity. When we look at a balance sheet, it's pretty clear that that's true. Assets, which is everything above this total assets line. Cash, current assets, inventory, things like that. Fixed assets, buildings, any kind of furniture and fixtures, that kind of thing. Rich, did you have a question? Oh,
no, sorry about that.
No, you're good. Okay, and then liabilities, my total liabilities plus my total equity equal, that 583 equals what my total assets are. So anytime we make an entry in our books, it's going to affect one of these things. There's not a lot that is going to cross over from the profit and loss to the balance sheet until the end of the year. The only thing that crosses will show up in the equity section, and it'll be in my net income. So my common stock or my partner's capital or those kinds of things, plus paid in capital, plus whatever my earnings are, that will affect what my balance sheet looks like. And it usually, on the asset side, affects what my bank balance is on a regular basis, or what my inventory is. And we can make those adjustments. So the things that I hear most often for basics, they're like, help me understand what happens in my bank. Help me understand what happens on my credit card. Help me understand how to record a loan payment. How do I enter an asset? How do I do a loan payment? And what do I need to keep for records? So I'm kind of giving you a preview, but that's what we're going to cover really quick. I'm going to go over those things. Please chime in and stop me if you have a question, or if there is something else that you would like to cover during this because I can kind of stretch it out or make it as short as possible. All right. So let's go back to our bank balance. So checking accounts increase with a debit and decrease with a credit. So I'm going to go to only journal entries. I'm not going to teach you QuickBooks right now. We're just going to go through what happens behind the scenes and how to build books or to make those adjustments, unless you want me to go through QuickBooks. Okay. So I'm going to go to make general journal entries. I'm going to say, okay, under this circumstance, I sold $15,000 worth of widgets to somebody, or I have a service, and I'm going to say, okay, on today, so 6:30, my entry, we're going to do entry 2, I had sales, so sales. My income, I'm going to go back to my spreadsheet, income or revenue accounts are credits, and they hold credit balances, and they go up with a credit. So my sales is going to be a credit. I'm going to say, okay, I have a credit of $15,000, and I would put record sale to Bob, or who cares? Okay, to Bob. And then where does it go? This $15,000 came in the form of cash, and so I would say I want it to go to my bank, and then I would record this transaction. And if I record this transaction, a couple of things are going to happen. So I'm going to save and new. I'm going to go back to my balance sheet. You guys are going to see that my bank balance increased by $15,000. And I got revenue, so my net income also went up by $15,000, thereby making sure that my assets and my liabilities and equity stayed equal. Okay, back to my make general journal entries. Back up one. Okay, let's say that Bob gave me $10,000 in cash and $5,000 he was going to pay me later. This happens all the time. This would be my accounts receivable. Oops, accounts receivable. We're going to make it specific so we don't break this. We're going to call it, say, Bob AR. We're going to create a new account. And this, I'm going to say, I'm going to set up this account. So I'm going to do an account type. I'm going to say, okay, well, this is a current asset because Bob is going to pay me, and I could actually put it under accounts receivable if I wish, but I'm going to put it under other current asset in case I try to use it for something else, and it doesn't. QuickBooks doesn't love having more than one accounts receivable account. So we're going to put it under other current asset. Account receivable is a current asset, so we're not breaking any rules. And we're going to hit close and save and close. I'm going to say, okay, save and close. Yes, I'd like to do this transaction. I'm going to go back to my balance sheet. And you're going to see, oh, well, my bank balance only went up by 10,000, but my accounts receivable went up by 5,000. There's my 15. And my net income went up by 15. If I were on accrual basis, I'm not going to get into basis of accounting. Let's not do that. I'll just say that my net income increased by $15,000, thereby keeping my balance sheet in balance. Any questions on how that works? Okay. Normally, if I were using QuickBooks or something to that effect, I would have created an invoice. Go ahead. Go ahead.
If, let's just say we're using something super simple like
a spreadsheet?
Excel. Yeah, do we have to worry about double entry?
Yes.
And why is that?
Well, when you say you're working on something very, very simple like Excel, let's say, for instance, I was just going to take, we're going to go back to my balance sheet. I'm going to go, okay, I'm only going to look at my register. I'm going to say, I only want my register. So let's go look at my register. No, I don't want that. I want to go, sorry, Control R. I want to go to my register. There we go. So there's only 2 entries in my register. This is $12,000 I put as a journal entry and then $10,000 that I received. If I am looking at a bank account only, and I am tracking where the money came from and where it's going on an Excel spreadsheet. So let's. I often see, okay, I have bank balance, $12,000. Okay, I'm beginning of the month. And then I have expenses. I have things like, okay, so I have a deposit for 1,000, and then I have truck payment for 700, and I have distribution to myself or owner's draw for 1,200 for that week. Let's just say. Let's say I'm going to just do my little net here. Okay. Let's not put it there. Let's put it way down here in case we add something. Okay, so my net at the end, there's my net balance or my balance in my checking account at the end of the month. Fine. What does a truck payment always have included in it? Interest and principal, right? And if I have a draw, you're right, absolutely. This is going to show me my bank balance, but is this a balance sheet item or an actual expense, a P&L item?
And by P&L, do you mean something that's deductible for tax purposes?
I mean that, no, I just meant that it's listed as an expense rather than as some kind of equity adjustment. So
And is that by rules of accounting that is listed as an expense that you're talking about?
Yes, a draw is not an expense. It is definitely an adjustment to my bank balance. It made my bank balance go down, so it is a credit, but it's also by the rules of accounting or taxes or, yes, by those rules, a draw is considered a piece of equity. So it would be better for when you're preparing for taxes. Mostly it's for understanding what you're actually going to be taxed on. So for my basic or my simple clients, I don't necessarily tell them, oh yeah, I get QuickBooks Online and end up spending $30 a month. Don't necessarily do that. You can absolutely keep all of your income and expenses tracked in a bank balance. The problem is that you get down to the end and you go, oh, I only have to pay tax on $11,000. Well, not really, because of this truck payment, let's say $600 of it is principal. Oops, let's skip a line. $600 is principal and $100 is interest. Only the $100 piece is a reduction on my profit and loss. So that's misleading. And a draw doesn't go on my profit and loss at all. It's a balance sheet. I'm going to put balance sheet on this right here. Here's a balance sheet. And these are P&L. Oops. And loss. Okay. And this would be all here as a draw. So it is misleading. I understand what you're saying. It's just misleading for a customer. And so it helps to have because if I'm looking at this as, oh, my net cash is also my net income, I have not done myself any good. I end up paying tax on $1,800 that I wasn't expecting. So I have $1,800 of additional income. Did that make sense? Or did I completely blow it all? I know that half of you are distracted doing something else, but I wanted to make sure that the reason that we do double entry bookkeeping is because if I'm a corporation or I plan on doing, I have any kind of entity, a partnership, a corporation, the double entry bookkeeping is typically required for those things to make sure that I am tracking my equity. The only time it is not is when I have a sole proprietorship or even a general partnership. I still have to file a balance sheet at the end of the year, but it is not required necessarily by the IRS that it is perfectly accurate. They let you get away with a lot when it's just a general partnership or it's a sole proprietorship from the tax perspective. Other than that, we are required to do double entry bookkeeping. So even if you're keeping it on a spreadsheet, we want to make sure that we have a chart of accounts that is, or we have a list, we have our list set up properly so that when we put something to, okay, I have my truck payment, that I know which portion is going to show up as an expense and which portion is going to show up as a reduction of my loan balance.
So I have a question.
Sure, shoot.
So what I do in my cookbooks is I list my car payment as an owner draw. And then if I take anything else as an owner draw that I'm spending on my own. So would that not all be that would be considered an income, right? So instead of marking it as a car payment, I just take owner draw. So
That is
track of my principal and my interest. So
that is a good question. And so I'm glad you brought that up. There is a difference between cash and profit. And so is it possible that I'm going to go back to my making general journal entries. Okay, let's go back to my balance sheet so you can at least focus on a couple of things. So I have credit cards here for $25,000. What if I took out a loan? What if I got a PPP loan from SBA or something like that? And I have a loan for an additional $100,000. That additional loan, it's not income. In fact, if I came in here to my general journal entries and I said, okay, let's do save and new, we'll do it on today. So I have, we can even make it a personal loan. So loan from dad. Oh my gosh, I can't spell. If I did that, I'm just gonna go and stick it in as loan, but no, I'm not. I don't love that. Long-term liability. Okay. I'm gonna do loan from dad, and let's say I get $100,000 from dad. Helps if I do the right number of zeros. Okay. And that goes into my bank. When I go back to my balance sheet, now I have $100,000 in cash, so I have more cash, but that is not considered income. The reverse is also true. If I take my car payments as draws, yes, you're out cash, but it is not an expense. So when I take a draw, I would come in here. Normally, I would just do this in the bank. I mean, I would go to my little bank account, but I'm going to treat it just like we would doing the long version of doing a journal entry, or treating it like almost like you would on an Excel spreadsheet. You're just putting that one entry in, and you can just link the cells and say, well, take this. This is a draw, and it does not affect my net profit. It affects my balance sheet. So I'm going to go over here. I'm going to say draw, or shareholder distribution is what it's called on here. I'm going to say, okay, my distribution was $10,000. And it's going to come out of my bank. Same close. So my bank went down by 10,000 and my shareholder distribution went up. But if I come up here to reports and I go to my company financial and I go to my profit and loss, and I'm going to do this full year just in case we missed. I did anything early this year. Oops, not last year, this year. I am only showing the $15,000 worth of sales that we recorded before, and not the loan because it's not considered income, and not the draw because it's not considered an expense. I hope that answered your question, Leah.
Kind of.
Okay.
Kind of. because what I look at it is that's kind of my payment to myself, so that's taxable because it's money I took out for personal.
Okay,
Kind of how I look at it. So
okay.
I'm in a LLC, sole proprietor, so I know it all goes into my personal anyway.
Okay. So Leah, I want you to imagine that in 2019, you left $20,000 in your bank, in your business. You didn't take it out.
Right.
Would you still be taxed on that 20 grand? Imagine you made money. Sorry, I'll do it better. Imagine that you made $20,000 and then you left it in your bank
No.
from 2019.
No. So I won't be taxed on it this year because I was taxed on it last year.
Exactly. But you still had cash. We call that retained earnings. So sometimes I can take a draw off of old earnings, old things that I paid tax on as well, and that do not show up on my profit and loss, but I get to take them, and it is your money, but you already got taxed on it. And I just want that piece needs to be clear as well. Because you could have been taxed on a whole bunch of money and you could be accumulating funds in a business savings account or a business, any kind of account. But you could be accumulating that money in a brokerage account for the business or anything like that. And once it's been taxed, it doesn't get taxed again, but you can utilize that money anytime you wish.
Oh,
And
wow. That's a new thought.
it does not show up on the balance, on the profit and loss statement ever, because it's a draw.
Huh. Good to know. Thank you.
So that is an important distinction. Okay. Any other questions? I am going to move on to our next little point, which is, I hope you all understand, that's how we increase our bank account. The big things is we increase the bank account by a debit, so money comes in. We decrease it by a credit, it goes out. And I hope I covered how it was recorded. We kind of did it fast. We had the money go out as a draw. It could also go out as an expense. And so I didn't show you that. So if we were going to go to, well, I closed it, sorry. So if I said, oh, I'm going to buy office supplies and we're going to spend $1,000 in office, and it's going to come out of my bank, I would record that, and then I would have a reduction in my bank of the $1,000, and then on my P&L, I would have $1,000 worth of expense, and my net profit would be the $15,000 I showed as income minus the $1,000 that I have as that expense. So back to I increase by debits, decrease by credits, and it is recorded. I think I hope I have covered that. Let me know if I haven't. I can always go back. Credit cards. Most people ask me not necessarily how to increase and how to decrease or how it's recorded, but oftentimes what I see in bank accounts is that people will show their credit cards as expenses. They'll say, oh, they'll never link their credit card. They'll never attach their credit card to their business. They'll just say, oh, well, this credit card is 100% business, and so every payment I make to it is business related. Totally understand that thinking. That makes perfect sense if all I do is online banking. And my millennials have never seen a credit card, what do we call it, check register, not any of them. They don't even know what that is. So they make this mistake on a regular basis. So I'm going to go back to my balance sheet. And my example here, there's a $25,000 worth of credit card payments or credit card balance. So it's attached. But I have all the time people go, even though they attach, they go, oh, I'm going to just make my payments and I'm going to do it, it's to a separate credit card. And they just show it as an expense. It is not an expense. Those payments to the credit card. Would you guys prefer that I do it out of the check register so it looks the same as what we're used to, or do you like it the journal entry way?
I like the journal entries.
Okay. So if I go to my journal entry, I would say, okay, I am going to make a payment from my checking account to my credit card, but it is not a credit card attached to this business. It's a personal card that I wrote something off, but I only use it for business. I just never got around to linking it. So I'm going to say, oh, I just paid that to credit card, and we just call this office expense again. And I just made a $3,000 payment to my credit card. You can call it personal card payment. They say, oh, okay, it came out of my bank. No problems. What did I just do wrong?
You didn't categorize where the payments went to, so you can't
So
track.
in this way, like you, and you're very familiar with this, Leah, so I'm very grateful for you participating. I eliminate my ability to reconcile very well. I don't take all of the deductions or all of the expenses that the credit card had. I'm just taking my payment. And so if I had a balance, let's say I opened a credit card in June of this year, and I have a balance in December when it rolls over, I missed expenses for December, for 2020, because I didn't record all of the expenses that were supposed to have been recorded. So what I should have done is say, oh, on June 1st of 2020, I bought a computer. Or I had, we could do that. Let's say I'm going to buy an Apple. That would be terrible. I bought a Dell computer. I bought Dell computer. I'd say, okay, well, that Dell computer, that is a fixed asset. So I'm going to continue because it's going to show up on my balance sheet. I bought my Dell and I spent $2,000. And then I also spent, on that same day, I bought a printer, a bunch of other stuff. And I'm not going to categorize all of it, but let's say that I did, I paid my accountant. So I have my accounting, my professional fees. And I paid that person $300. And I also had some licensing. I'm trying to work on my miles. And I spent $150 for that. And now this is my credit card. I can't remember, I just call it credit cards, I guess. And I would say save and close. Now when I go back to my balance sheet, my credit card balance has increased by $2,450, but nothing else happened to my bank. Then when I went back to my journal entry, I'm going to find it this way. Where's my credit card? Loan to dad, off supplies, there it is, right there. Then when I made my $3,000 payment to my credit card, instead of having it go to office supplies, I would have it go to my credit card. So then the payment goes to reduce the balance of my credit card, and the amount comes out of my bank. And that is the appropriate way to record that transaction. So when I go back to my bank is right now because the $3,000 left, and my credit card is also accurate because I made a $3,000 payment to that. I know that I said it was a separate credit card, but it was just for illustrative purposes. That credit card balance is now right, and both things can be reconciled. So that's important, and one of the things that I see on a regular basis. Any questions at this point? Austin, you got that look on your face. I've seen this 1,000 times. Let's go to one thing that affects all of us, and whether you're using software or you're using a spreadsheet, let's go through the purchase of an asset. What is the rules? The rules are, I am required to write down the total acquisition of the thing. So the cost of the truck, the sales, or whatever the asset is, the sales tax, any amounts that I spent to get the thing in working order, to have it delivered or software installed or any of those kinds of things, all go into the total cost of the acquisition. That is something that I often see that is also misunderstood is if I'm going to record an asset, I'm going to go back to my journal entry. Oops. And let's purchase the truck. Oh, let's do something better. Let's do a truck. So I'm going to purchase a truck. I'm going to purchase a truck for, let's say, $35,000. But I also have taxes and license and all that kind of stuff. So it comes out to $37,381.22. Did I finance this? Did I come with cash? How did this transaction work? And this is the kind of the essence of a journal entry. When we go back here, did I put in cash? Did I take out a loan? Is any of it a trade-in? And am I capturing the total acquisition cost? Because oftentimes I see, oh, well, we bought a house. And so we put $5,000 worth of earnest money 2 weeks before. And we also had additional costs for that aren't even on the closing statement for an appraisal and a couple of other things that happened before the fact. All of that stuff needs to be included in my books to capture the total cost or the total acquisition cost. So let's say I have a truck and I put in cash from my bank of $2,000. So that will reduce my bank by $2,000. And the rest I have on there, we're going to call this truck loan. Okay. And whether I'm doing this in software or whether I am tracking it on a spreadsheet, my spreadsheet should have one tab where I'm tracking all of my assets and liabilities or my loans, my liabilities, and one tab for my P&L. So even when I build these for, like I built one for my sister on a spreadsheet because she didn't want to buy QuickBooks. And when we went through just a really simple balance sheet and profit and loss, she only has a few expenses. I created those tabs and then just linked the cells so that it would pull the data when she had, so that she knew where it was going, and then just created those, you know, the month tabs along the bottom so she knew where everything was going to end up. And then she could just send it to me at the end of the year to do her taxes. And I would just check to make sure that none of those calculations had been broken. Those links were still there. And it did track the credit card that she was paying, that she got 0% interest on for 6 months. And we were able to do those reconciliations and make sure that it was right, and it holds up. So to your question, Austin, it isn't always the easiest to track, but it is more correct and helps with what I call the 3-second test. I always assume that people don't really love accounting. It helps them make decisions, but mostly it's like the scoreboard in the game. If we want to see how the game is going, it would be really boring to show up to a football game and have nobody keep score. So accounting keeps score, and we should be able to see the scoreboard and know what's going on in under 5 seconds. We should be able to go, okay, here's my net profit, here's what's happening. If I want to compare it to last month, you know, just like I would go to a football game and say, okay, what down are we? Who's got possession? Which direction are they track? You know, that kind of stuff. What's the score? It's 21-7, that kind of thing. So think of accounting and my financial reports as the scoreboard for your business. So I'm going to go back. This is how I would record a truck if I purchased the truck. So now I'm going to ask a question. What if I had a trade-in? So I'm going to do this in 2 pieces, but it can be combined. This could all be on the same journal entry, but I'm going to do it in 2 separate pieces so I can walk you through and we can say, okay, well, this is where I got this dollar amount. Here's where I got this dollar amount. And then we could show it reversing out and show what happens on a trade-in. Normally I put them in because you would want the value right here to show up as the truck loan. But here's my truck. Here's my total acquisition cost. I know that that is the correct amount. I know that the $2,000 that I paid out of my bank, that is also the correct amount. If those two are correct, then the truck loan cannot be $35,000, especially if I put $2,000 down. But people go, I don't know how to record that. So here's how we do it. We would say, okay, let's look at our balance sheet. We had an existing, we might have had an existing truck or existing thing, existing computer. Well, we're going to use my computer, whatever. Or let's say that I had an existing truck. Let's go put that in really fast. I thought I already had. I'm sorry, guys. 12/31/19. Truck. Good. Let's say that I spent $25,000 for it. And let's just say it's all paid off. So this would go to my opening balance equity. Save new. Yep. So on my balance sheet, I now have a truck. I have truck old for $25,000. How did this? See, I did have truck on there. I just called it truck. That's why we have a problem. Bear with me all. I am sorry. Okay. 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 So you can see that I had old truck for $40,000 and I have $80,000 of accumulated depreciation. I did not separate that out and I should have for illustrative purposes. Let's say that $20,000 of that accumulated depreciation belong to this old truck. Truck 2 is the one that we bought this year that we just showed. We bought a new truck and that was the total acquisition cost at $37,000. Let's say that we sold this back. We traded it into the dealer and we got $5,000 worth of credit for it. And remember that $20,000 of the accumulated depreciation also belongs to this. So we would say, okay, we have on my, oops, I almost closed it again. So we are going to record, as of today, when we bought the truck number 2, we're going to record the sale of truck number 1, the $40,000. The first thing I would do is I would take this, I'm going to take this $40,000 out. So I'm going to say, okay, it's called truck. And I would do the same thing if I were working on a spreadsheet, because I want to know how much I'm actually going to be taxed on the sale of this asset. Now, so I'm crediting the truck because I'm removing it from the balance sheet completely because we sold it. So I go back to my balance sheet and say, okay, now $20,000 of this accumulated depreciation belongs to this truck. So I'd say, okay, accumulated depreciation, I'm going to take $20,000 out. That leaves me with $20,000. I got, remember that we want to reduce the loan that I got. I don't love that. That's not going to be easy to understand. So I'm going to just do this way. So I got 20, I'm taking the truck off of and my book value which is the cost of the vehicle minus its accumulated depreciation. That's my book value. My book value is $20,000 left over. And let's say that my trade-in was only $5,000. So I would say, oh, well, I got a trade-in, so I got a value of $5,000 on the new truck loan. Because they gave me a reduction of $5,000 on that loan. So they gave me $5,000. It's essentially what that says. And this right here is my loss on the sale of this vehicle. Not that anybody would do this, but if it shows up as a debit balance, you lost money. You had book value of $20,000. You only got $5,000 for it. And so $15,000 is the loss on this truck. It could also be that you got $25,000 worth of trade-in, in which case we would put you would record, I got $25,000, so my loan would be reduced by $25,000. And I would have gain on the sale. Gain on sale of asset. Sale of asset. Of where are you? Here you are. Of $5,000. I know that didn't make sense. Ask the questions. Or if it did, then you guys are geniuses and you all would have gotten A's in my accounting class in college. So
You're just talking bigger numbers than I'm used to. But I think I think what you're trying to say is just the part of the accountability is seeing what you actually have acquired to what you've lost.
yes. And I did it in 2 journal entries instead of 1.
Right.
I can do
So-
this exact same thing on that same journal entry as we did on the sale of on the purchase of the truck. We could also take all of this off because they both balance and say, oh, well, we got this much as a trade-in, and it would go in as part of that, as that one journal entry. And so you could see, well, I made this on the sale and I made this on the purchase, or I spent this on the
To
purchase.
break it, so you're breaking it down so you know exactly where everything went. So that's kind of the double entry that you're talking about.
Yes, and it also shows, because I have this, if it was the first way, where I only got $5,000 for it, I would have a loss of $15,000 on my P&L. So when I go to my P&L, I would have a loss of $15,000, which would come off of my income when I go to do my taxes, or I'm looking at my scoreboard. The reverse is also true. That if instead of having a loss, I ended up having $25,000 as a trade-in, and I had $5,000 as a gain, when I go back to my, wrong one. When I go back to my profit and loss, I have $5,000 worth of gain, and so I would need to pay more tax. This often gets overlooked because people forget that they depreciate their cars. So they forget that they took an expense. If you take mileage, this is not an issue because you never depreciated anything. I had a lady, and this is a tax versus accounting question, and most people that are in small business account everything based on cash and they want to know how much they pay tax on. So we have not been discussing accrual basis or anything like that. But I had a lady who bought a new Escalade and said, I'm going to keep this Escalade. There's no way I'm going to sell it. I love this car. I want to depreciate as much as I can. So we depreciated $80,000 of her car. And then 2 years later, she sold it. And she sold it for, I think it was 50 grand, 55 grand, somewhere in that neighborhood. But because we had depreciated the whole thing the first year, the entire sale was totally taxable to her. And so that she got to add 55,000, I don't remember, but she got to add that $50,000 in the sales price of the vehicle back onto her taxes, and it went into her profit and loss for that year because she depreciated the whole thing. So understanding how that works and kind of keeping track of my assets and my liabilities are very important, because I can sell something for a gain and still have a liability attached. So I can pay tax and still owe money on it. That happens rarely, but it does happen. And so we want to make sure that we know where the money comes in, the character of the money, and how it leaves, and the character of that money. Okay. Recording loan payments. This is very, very simple, but just like in our first example, when we stuck it on our P&L, we just stuck it in our check register on our spreadsheet, the truck payment needs to be broken into its constituent parts. So the payment it shows up as a credit. I'm sorry, payment is a debit, and it's broken into two parts. It is the interest part and the reduction of the loan part. So those are the debit pieces, and then the credit is wherever the money came from. So if it came in cash, you just handed the person cash, it came from cash. If it came from the bank, it came from the bank account. If it came from, I transferred money, if it came from a credit card, it would come from a credit card that way. But that payment needs to be broken into its constituent parts. It'll look just like this. So if I was going to make a truck payment, truck payment 2 has the balance on it. I'd say, okay, truck payment 2, is $700. $600 is the reduction in my truck payment 2. If I go back to my balance sheet, that's see, look at me blowing it. I would have put it in the wrong place. That is not right. I want the truck loan. It is a reduction of the truck loan. Then I would have interest expense of $100. And then I would have where it came from is the bank. I spent $700 and it came out of the bank. And that is the appropriate way to record a payment of anything that has interest attached. The balance, or the principal piece, the interest piece, and where it came from. Okay. Any questions?
Yeah, I have a question on the loans and depreciation.
Okay, I'm ready.
You're just keeping your own books, small business owner.
Yep.
And are you expected to know the breakdown in principal and interest each month that you're doing that?
There is supposed to be a statement. So on the majority of loans, you can get an amortization schedule, or you look at your statement and you break out the portions of the payment that apply, or you can do it annually. If you're just keeping your books, there's a lot of phone calls that get made at the end of the year and go, what was my balance on my loan? So if I made $700 a month payments, I know that I paid $8,400 for an entire year. But my balance only went down by $5,400. I know I spent $3,000 in interest. And so if I were going to record that at the end of the year, because I was doing it shorthand, I would say interest expense, $3,000, and I would then credit or increase the balance on the loan. So I'm going to go back to my truck loan by that $3,000, because $3,000 of my $700 a month every month was interest. Did that make sense?
Yeah.
Good. So you can record it anytime you want. It just make sure you're not doing it any less often than annually. So you make sure that your books are correct at least once a year. For doing taxes, it's like a broken watch. You want it's at least right twice a day. So you want to make sure that your books are right when you're doing your taxes or you're providing statements to the bank or things like that. Make sure the financial statements are accurate. Okay. Any other small business? I've been doing accounting for so long that I forget what would be questions. So if I have blown it and made it way too hard, I apologize. I was just building the class based on what I get asked or what I see as mistakes more often than anything else.
So now that you brought this up, I have a question. Let's say I bought an item for my business that runs my business.
Okay.
And they depreciated all the way down. So
Okay.
I sold some of those items for $100 less. So I'm taxed on that part that's been depreciated, right? Would it be better to sell less and save on the taxes, or is it, I mean, I guess that's kind of a weird question, but.
So I'm going to answer this question with kind of a funny story. So I have a doctor who's married to a doctor. And Doctor 1 is a cardiovascular, he's a heart surgeon, okay? And he's the head of heart surgery at Loma Linda Medical. And he made about 700 grand. And his wife was a breast surgeon, and she made about 250, 300,000, right in there. And he goes, oh my gosh, we're doing taxes. And he says, why she shouldn't even work. I mean, we just spend all of her income that goes to taxes. And I said, right. And he goes, well, she should just stop working. And I said, well, if she stopped working, then you would spend 40% of your wage, 30% and change, on taxes. So isn't it better, since tax is not 100%, to keep more cash? If you make more money, you do get to keep some of it. We're not 100% taxed. So she works so that you get to keep all of your income. And he laughed and he goes, yeah, that's right. So the same rule holds true. We would, because tax isn't 100% and then they give us back some, we only have to pay a percentage. It's nearly always better to sell the item for as much as you can get for it, and then just pay tax on the, what would you call it, the recapture of that depreciation.
Okay, good. I didn't. Thanks.
Yep. Oh, there's the side of my head. Terrible. Okay. Anything else? Because the last thing we're going to go over is record keeping. I get asked this frequently as well, and this is pretty important. For record keeping, I would tell you, if it's property related, don't ever get rid of it. Not ever. As long as you still own the property, so you want to keep records of property that you have owned for the entire time that you own it, plus 4 years. So if you sell that property, you're fine destroying all of the data after 4 years after you sell it. Otherwise, keep it. Keep every refinance, every 1031 exchange, everything. Keep it all forever until 4 years after you have sold it. Okay?
Including
Go ahead.
including leases and rental applications.
Rental applications, not that long. I just meant when you acquire something. If I said that wrong, I apologize. So if you're going to rent or lease, if it's I'm renting a property, then keep the lease agreement for as long as you're in it, and then add 4 years. The statute of limitation for all taxing authorities, as far as I know, federal is 3. Most states add a year or are the same as federal. I don't know anybody that adds 2. So within 4 years, that's the statute of limitation for all things income tax related.
Okay.
Austin would probably chime into this and probably say, hey, he might say it's better to keep it for a little bit longer because he does the legal world, but that's for tax purposes. And that's as long as anybody could come back and get you, unless you've done something really wrong. If you do something really wrong, they can go back 6 years or forever if you've committed fraud. But the rule of thumb is if you're honest, 4 years is it. And that covers both the federal and the state statute of limitation. And then you can start purging those records.
Yeah, and so just to check.
So go ahead. What were you saying, Austin?
From the legal side, in Utah, they can come after you for 6 years for legal liabilities on anything that's written. If there's a written contract involved or something, then it's 6 year statute of limitations. So on a lease agreement, for example, if you're worried about any kind of liability, you can keep it for that 6 year time. The tax authorities won't come after you, but if your tenant has an issue with you, he brings it up later or something, you take 6 years.
Okay, so 6 years. I will add that to my understanding as well. IRS came out with a funny kind of blurb at the top of all of its what do we call them? Instructions for 941s and 1099s and things like that. They basically said, look, if you make a mistake and it's under $100, we don't care. Just we're okay with $100. And so just recently, in the last couple of years, they've said if you have receipts that are less than $100, we don't care. Just it's fine if you don't keep those. We can go to credit card statements and things like that if we have to find those tiny amounts, but you don't have to keep receipts. But for normal record keeping, bookkeeping stuff, you want to keep your receipts for that same 4 years. Credit card statements, bank statements, mileage logs, rental logs. This has become an issue because the IRS has asked for contemporaneous records in tracking how much time someone is spending on a rental. And they're now counting any kind of repair person's time, or if you have yard maintenance done, you're able to count anybody that works on the property's time for it as well. So that's why rental logs are listed on there. Bad debts need to be, or any worthless securities. Those need to be kept for a 6 year time frame. Payroll records, sales tax records, they have different statutes, but payroll records, I think, go along with the contracts. And when it comes to, they can't go back on you when it comes to the statute of limitation for taxing. I think they can still come after you for employment law and things like that. So it's best to keep your payroll and sales tax records for 6 years. And all tax returns are about the same for that 4 year time frame. Any modification to that, Austin, from the legal side?
No, it's pretty standard. And in
Okay.
Utah, if you have an unwritten contract, it's only 4 years to sue on it. Written gives you a longer time. So.
Okay. Okay, everybody. I appreciate you hanging in here as long as you did. I hope it wasn't too terrible and you've learned something. This was fun for me to go back through. So thank you.
Thank you.
Thank you.
Thanks, Matt.
Yep.